Let me first ask what you make of this, Ted, this market crash, basically, that so many people have now compared to the U.S. stock market crash of 1929.
Yeah, well, it has one thing in common, which is a lot of first-time investors, a lot of public investors who are unsophisticated. And, you know, we know from prospect theory that the intensity of pain is much more intense than the intensity of pleasure on the way up. So when Chinese families start losing their savings, they would tend to panic. But, you know, you mentioned what you hear over and over again about the Greek crisis, last chance for this, last chance for that. You know, I've been on the China beat for a long time, and people have been writing the last chapter of the Chinese economic miracle for a long time. And I think thinking of this market crash as some way the end of China's miracle is way overblown.
Way overblown. I think about what Deng Xiaoping said, which is he framed the next stage of Chinese growth as socialism with Chinese characteristics. A lot of people have looked at the market meltdown this week and commented that this is kind of like capitalism 101, schooling China. I mean, your take on that is that's far from the case, but is what we're seeing kind of inevitable given that China was kind of going about it its own way?
Well, it's inevitable in markets in general. I was a trader at Chicago Mercantile Exchange for a long time, and you saw this exact same thing in pork bellies, and those were the most capitalist people in the world. I think the 101 part is the beginner steps that the Chinese administration, the current administration, took in encouraging the Chinese public to buy stocks as a way to prop up the economy and, in a way, manufacturing a bubble. And as people saw stocks go up, they thought they would be more capable as consumers, that it would also prop up real estate prices, and you just saw an overall asset bubble. And on the way down, I actually have to give the Chinese government credit. They may have taken some sloppy steps to prop up the market, but the Chinese public very much intends their mother, you know, their government to take care of them, and just showing that they're willing to step in forcefully gives the Chinese public a lot of confidence. I think that's even though we might not agree with the measures, the symbolism is very, very strong.
Right. You can't really call it confidence, though, Ted, when they order you not to sell stocks for 6 months. And that causes massive market problems, as any Chinese scholar would understand as well, everywhere else. I mean, if you force me to hold stocks and yet I need cash, then I have to sell real estate or my copper warehouse or my cars in order to get it. And they're going to cause problems elsewhere.
Well, 80% of these investors in the Chinese stock market are individual investors. They are not over that 5% threshold that prohibits you from selling stocks. Those would be the bigger players. The other side of this intervention is that state-owned industries have been asked to step in and buy stocks. Now, that seems very, very sloppy from our point of view, but it is the kind of forceful step that the Chinese government is expected to take by the Chinese people.
Right. Well, they've suspended, though, the smaller companies, right? And I think there were like 700 companies that were suspended a couple days ago, and they're obviously shoveling money into the bigger state-owned companies. I mean, in a way, they're kind of making this economy so lopsided.
Yeah, well, they're always willing to make the economy lopsided in favor of the state-owned industries. You know, the state-owned industries are a black box anyway. Who knows what their real valuation ought to be?
Yeah.
Yeah, we'll only know whether the symbolism counts when those other smaller companies are allowed to trade freely again. But I would not be surprised if they don't plummet, if they kind of stabilize as a result of this bigger action.
Ted, let's take a step back here, because what it comes down to for the Chinese government, whoever is in charge, is to avoid social unrest, right? Connect the dots for us here on how the government's effort to shift the economy from an export investment-driven economy to one that's more domestic demand-led and consumption-led helps diminish unrest, especially when you've got this kind of volatility.
Well, this is why the effort to prop up the stock market in the first place was so misguided. The government thought that by putting more money into the pockets of investors, by asking the investors themselves to drive up the market, they would feed the consumer economy. Obviously, that's not going to work if the bubble collapses. So that's going to be a failed attempt. Also, there's a lot of hidden consumer spending in the corporate sector in China. So a lot of the consumer goods that we would count on the consumer side in the U.S. economy are actually purchased by Chinese companies for their employees. So consumer spending is higher than we generally think of it. And if the bubble is collapsed for real, then you're going to see a huge double dip on consumer spending on the private side and also on the consumer goods that are paid for by companies.
Well, Ted, we look at all the numbers on the stock market in China and how dreadful it's been. But if you look at the economic fundamentals, it might tell you a different story. I've got a chart from Citigroup. It's the Economic Surprise Index for China. And what's critical here is that when you look at the chart and it dips below zero, it doesn't mean there's contraction. It just means that data is worse than expected. What we've seen is that it has improved a little bit. It's bottomed out. Does that mean the stimulus the government has introduced over the last couple of days and weeks is working?
I don't know if what's happened in the last couple of days and weeks is working, but when you do get a crisis, you will get increased discipline by the Chinese corporate sector, which should make China stronger in the long run. For the U.S., the question is different. If China is weaker in the long run, what does that mean for U.S. companies? It means that Chinese wage inflation will be over and that outsourcing will still be viable in China. So you'll get fewer jobs moving to other economies in Southeast Asia. And the ripple effects of a true collapse could be quite profound. But when we're talking about China, generally we're talking about not a recession. We're just talking about a decline in the growth rate. And the growth rate in China is still considerable for now.